What's up, everybody? It's Tuesday, July 19th. How you doing? Nice day today. Up big, up nice in the markets. All the averages were up. We got Netflix earnings after the close. Netflix popped higher. Interesting because they lost almost 1 million subscribers. I think it was like 990,000 subscribers, something like that, but the stock was higher. I said last week or a couple of weeks ago, I said that second quarter earnings, to the degree that they were negatively impacted by the economic contraction, which I still think we're going to see a negative print for second quarter GDP, and that would qualify as the definition, what economists hold as the definition for a recession, 2 negative quarters. I said that that's already priced into stocks. And when we get those earnings, I said, that's already in the rearview mirror. The market will be doing better. I focus on the fiscal flows, and I've been telling you that now things are starting to look pretty good. However, I have to mention that yesterday was a pretty sizable net drain. We saw a 21.4 billion net drain yesterday. It was a big tax day yesterday for some reason. I don't know. And so, whereas yesterday in my video I said, we only have to make up 48 billion to be equal to the level we were right before that big April tax drain. Remember, 324 billion. Unfortunately, now we got to make up 70 billion. So it just goes to show you can't be complacent. Very happy for today's rally. Yesterday's sell-off, in light of the fact that it was a pretty big net drain of 21.4 billion. It's understandable that the market failed to rally yesterday. That was just, a sucking sound, sucked out that liquidity. I don't have the numbers for today. We'll get that tomorrow in the daily treasury statement. And tomorrow, remember, tomorrow is a Social Security payment. So tomorrow we're going to get a net addition of about 24 billion. That's usually what we get on the Social Security days. So tomorrow wipes out what happened yesterday. We don't know what the flow was today, but I'm guessing it was positive just based on the market action. You see how these flows really affect, not just in the long term. I mean, in the long term, they affect the economy. It's the most important factor. It even is more important than bank credit, believe it or not. Because remember, with bank credit, it's great. Hey, you get money in your checking account, but you also have a debt that you have to start paying off every month, or whatever the term is. With fiscal, that's money in your pocket. That doesn't come with an offsetting liability. So that is, that's high-powered money. So as I said, I've explained to you guys, that we were in the clear. I think, what was it, Friday? I said, that's it. We're going to shoot up at least to the mid-June highs. Today, actually, we broke through some pretty good resistance in the S&P. If I'm looking at the S&P September futures contract, we got up above. Earlier, I sent out an email to my subscribers. I said 39.22 and 39.50. We busted through 39.22, but we didn't get above 39.50. Got close, but not yet there. So could see a pullback. I mean, again, yesterday was a big drain. We saw a market pullback yesterday. Today we were up. We'll get the numbers on that. And tomorrow is a Social Security payment. Now, when these flows start to normalize again, and by normalize, I mean we need to recover that April tax drain. We were close. We were getting real close. 48 billion left to go, but now it's 70 billion left to go. We're going to do it because August is going to be a big month with the quarterly interest payments, so I'm not worried about that. We're going to do it. But you can't, you can't become less vigilant. By that I mean, you got to be patient. The market is going to have pullbacks. The way you want to play this is to buy those pullbacks or to use those pullbacks to exit. I said this yesterday, use the pullbacks to exit. Actually, I said this on Friday. I said use the pullbacks to exit defensive positions, maybe short positions if you have puts on. If you have inverse ETFs, I mean, when you get a pullback, that's your opportunity to exit and then build back your long position. I should mention too that a lot of people, there's still a very high level of bearish sentiment because a lot of people understand that the Fed really hasn't started quantitative tightening at the at the rate that it's expected to go. Okay, they're supposed to ramp it up to 95 billion. Well, we're having 3 months, I think, what was it, like 45 billion or something like that. So it's proceeding slowly, and a lot of people, for them, and this goes back to something I said a long time ago, that personally myself, I can't wait until the quantitative tightening, because I've explained this, it's not a tightening. All right, I mean, it's really what it is, two things. It's allowing the economy to have those interest-bearing securities as opposed to the Fed having those securities, stripping that interest income out of the economy. It goes into the economy instead. Okay? And secondly, it's going to help drain reserves, which the banks need. And for those of you who haven't been following along yet, well, what do you talk about? Of course the banks need reserves. No, they don't. I mean, the Fed had to create, the banks only need what is required reserves, okay? And we got 18 trillion in deposits, so 10% of that is 1.8 trillion. That would qualify, that would meet the regulatory mandates. But we got 3.3 trillion in reserves. So the Fed has literally had to create a separate vehicle, that reverse repo facility, for the banks and money markets to shunt the reserves off into that facility. And they don't want it. They're like, hey, we don't, we got enough. We're all full up here. Okay, we don't. So the Fed really needs to get going. So I like it that everybody is still, they're looking out there through a very bearish lens, because they think, oh man, once that QT really gets going, man, that's going to be bad, because that's liquidity tightening. It's not liquidity tightening. If anything, it's going to allow the banks to increase their loan creation, increase their loan books. That's another reason why I'm really bullish on the bank stocks. I mean, these stocks have been so beaten down, and it's understandable in one regard, because the rate hikes by the Fed and the talking about the rate hikes, which has actually jacked up bond yields and sent the bond market into a tailspin over the last year, that has negatively impacted the positions in securities holdings of the banks, which have to be marked to market. So that's a huge hit that they have taken, and the stocks, okay, the stocks reflect that. But it's not reflecting now what's going to happen on the upside when you start to see that reserve drain and you start to see more lending. And again, there's definitely capacity there, because I'll mention it one more time. I mean, debt service burdens are still historically low. I think they're under 10%. The peak we saw historically, the highest it ever got, was in 2007, when household debt service burdens, in other words, how much does it cost to pay your debts every month, that got up to something about almost like 14% of disposable income, and that was unsustainable. And then, we're down like around 9.6%. So, I mean, it's still very I mean, it's not a problem. It doesn't present a problem. So I can't wait for the QT to get going. I mean, I like the fact that the sentiment is, you know, at least with regard to how investors perceive quantitative tightening. You know, it has that word in there, tightening. So what do you expect they're going to think? You know, they're going to think that simply because that's how it's been labeled. They're not going to think, oh, it's called quantitative tightening, so it must be an expansion. No, they're not. They've been, you see how they get trained into thinking a certain way by flawed understanding, a bad understanding. It's a bad understanding, like so much of economics. This is just a bad understanding. I mean, there's I would say most people believe, you know, that the banks lend out their reserves, like they get some money and they lend it out. No, the loans itself create reserves. I mean, this is, you know, I always get a kick out of that. Yeah, because people think we're operating in the, you know, It's a Wonderful Life world, the Jimmy Stewart, Bailey Building and Loan. If you've ever seen that movie. Great movie, by the way. I watch it every Christmas Eve. So, yeah, I mean, a good day today. Fiscal is getting back to normal. Had a little bit of a setback yesterday. I have to, you know, let you know about that, which I did. Pretty big drain yesterday for an average day. That was just, I don't know, there was a 30 billion tax. And that was on employment and withholding taxes. What was yesterday? Yesterday was July 18th. I don't know why that was such a big draw, tax drain. I don't know. Anyway, it was. So it was like a 21.4 net drain when you take the spending minus the taxes, and that set us back. So the deficit right now for July, remember we were running nice with a 135 billion deficit, and we were only 48 billion from closing the gap with that April 18th massive tax drain. But now we got to recover 70 billion. It's going to happen. It's just going to take a little bit longer. Tomorrow we get about a 24 billion net flow from Social Security, and that's going to help. So we're in a bullish mode, folks. I called it for you. I said we're going to be in a bullish mode at least until mid-September. Mid-September, of course, we're going to get another quarterly corporate tax payment, and we're going to get into the wrangling over the budget, right? A budget has to be finalized, or a continuing resolution by the end of September, by September 30th. All that political stuff is going to happen, and we can start thinking about the midterms. It's going to get fun, right? It's going to get wild. But right now, you got a chance to make some money. Here's one more thing I'm going to mention. On Thursday is the ECB meeting. Now, the ECB is expected to raise rates. They're going to go from 0 to 25. That's going to be the first, I believe that's the first rate increase by the ECB in 14 years. And I'm saying that's going to be negative for the euro. All right? I'm shorting that on Thursday. We'll see what happens. All right, folks, that's it for today. Don't forget, if you want a copy of my report, MMT Trader, I'm the only one who has an applied approach to MMT. I take the concepts and understandings of modern monetary theory, and I use that to invest and trade in the financial markets. Go to my website. The link is in the description below. Sign up for a 30-day free trial. Bye.